Welcome back, everyone. In this episode, we're going to be talking about market inefficiencies. By the end of this video, you're going to learn the different kinds of market inefficiencies, how to use them, not just for a trade setup, but how to use them to predict price movements. All right, so what's market inefficiency? An efficient market is one where every price level is traded fairly. But in forex, that rarely happens. When the market skips prices, it leaves inefficiencies. And these areas often act like magnets. All right, let me show you what I mean. Market inefficiencies refer to areas on the chart where price moved in an imbalanced way, leaving behind evidence that buyers and sellers didn't transact equally. So let's look at an example here. For instance, let's assume price is currently at $400.5. Okay. And then it quickly changed or moved to $400.1. This quick move creates what we call price inefficiency, meaning that when price was at this point and moved to this point, it didn't give the opportunity for the orders that were placed here to be executed. Okay, so what usually happens is that price moves into that area of inefficiency. So give an opportunity for those who missed this trade or who placed their orders here so that it can be executed. Now, I want you to understand that if you place a buy limit here or whatever order you place here, if market does not get to that price, that order will not be executed. So if price should jump from this level to this level, any order placed here would not be executed. Now, what the algorithm does is it usually goes back to that area of inefficiency. That is that area where there was a jump in price to give an opportunity for those orders that were placed here to be executed. So I hope that's clear. So all that the algorithm seeks to do is to balance imbalances. So if price moves away from an area, like a fast move, leaving an inefficiency, usually the market seems to go back to rebalance that area of imbalance. So that's the whole concept behind market inefficiency. So when we see a market inefficiency, we expect that price will get back there, giving us an opportunity to participate in a trade. So now, with the concept I just explained, how can we identify market inefficiency in price? When you open your chart, how do you know there's market inefficiency? So we have three kinds of market inefficiency. We have the fair value gap. This is when price moves in one side. Then we have volume imbalance. This is when there's absence of body volume. And then we have price gap. So what does this mean? So a fair value gap consists of three candles. We have 1, 2, 3. It has to be three candles. And it's formed when there's a gap between the first candle and the second candle, using the whole range. So when I mean the range, I mean you're using the high and the low. You're not using the bodies. You're using the high and the low. So if you draw out the high and draw out the low of the first candle, and you draw the high and draw the low of the second candle, the gap between the first and the second candle, this gap here is what we call a fair value gap. And it's when one-sided price is being offered. So we can see that the sell side here was offered, leaving this gap. All right, that's a fair value gap. Therefore, a volume imbalance is when there is absence of body. Now, the anatomy of a candlestick comprises of body and wicks. So here's the high, here's the price open, here's the price close. Okay, so this whole range from this point to this point is the body. And then this is the low. The low to the close is a wick. And then the high to the open is a wick. So we have wicks and bodies. So for a volume imbalance is when there is absence of body. So between these two candles, we could see that there is no body at this area here. So from here and to this point, we have a gap, although we see wicks in this area, but absence of body. From here, you can see that from this area here to this area here was filled with a body. But from here to this point, you can see a little gap here. This is what we call volume imbalance. The difference between a fair value gap and the volume imbalance is that a fair value gap is formed by 3 candles, but a volume imbalance is formed by 2 candles. Now let's look at the price gap. So a price gap is when there's an unoffered price range. Okay, so from this low to this high, you can see that there is nothing in between. So this is a gap, purely gap. So we have the fair value gap, the volume imbalance, and the price gap. These three are all market inefficiencies. Now I'll say it here. they all function similarly. So like I explained in the previous slide, when market leaves an area of inefficiency, price usually gets back to that point. So we are expecting price to return to this area of inefficiency, area of imbalance, to balance it out before continuing the trend. We also expect the same thing here for volume imbalance. We expect price to go back to this area of inefficiency before continuing going lower, and the same thing here. But there is a difference between the three. The fair value gap is the most strongest, but the volume imbalance and price gap, you usually see price trade through it up and down and still find support or resistance with this area. Okay, you could see a gap from the past after price has wicked through it and still find support or resistance later on in time. I hope that's clear. Don't worry, as we move on, I'll show you an example in the chat. But all you need to get from this is that the fair value gap is the most strongest PDRA. PD stands for premium discount. So premium discount array, I also call them institutional levels. These are levels where we expect price to find support or resistance. So like I explained, the fair value gap is formed by three candles: candle 1, candle 2, and candle 3. The gap between candle 1 and 2 is a fair value gap. Now, the fair value gap. And before I proceed, aside it being the strongest, every other thing I explained about the fair value gap is also applicable to the other two kinds of market inefficiencies. So the fair value gap is the strongest PDRA, and it represents speed and momentum in price delivery. What does this mean? Whenever you see fair value gap, it's telling you that there is speed and momentum in that direction. So if you see price move higher, creating fair value gaps, stating that market wants to keep going higher. It's an indication of speed and momentum. Speed and momentum at a particular direction, either higher or lower, is a telltale sign that price wants to keep going in that direction. So it helps determine bias. So if you see price creating fair value gaps going higher, it's saying that price wants to go higher. And if you see price creating fair value gaps going lower, it's saying that price wants to go lower. So it's a pointer to price direction. Okay. Another thing we should also know about the fair value gaps is that it creates high probability trade setups. Okay, you want to be working with fair value gaps. You want to be working with institutional levels that have the fair value gap. And I'll explain this in the next lecture to be released. Okay, so it is best applied for precision entries and clear targets. I gave 3 entry models, and all the entry models have the fair value gap included. From the whole concept of market inefficiencies, you understand that price usually returns to that area of fair value. So knowing this gives a very good quality to your trading edge. Clear targets should also be noted. Let's assume there's an area of inefficiency here, and then this is where you are buying. This can also be an area for targets because price usually returns to an area of inefficiency. So you could use them for both entries and targets. All right. So what are the high probability fair value gaps? Now, you need to understand the high probability fair value gaps from the low probability fair value gaps. All right. Not all fair value gaps have high probability of holding price. Okay. So I've been able to separate the high probability fair value gaps into 2 kinds. We have the graded levels and premium and discount. So what do I mean by the graded levels? Let me show you an example. So here's a fair value gap. When you identify your fair value gap, you want to grade it into 3 levels. So the first level is the high, second level is the midpoint, and the last level is the low of the fair value gap. You want to monitor price as it reacts at that fair value gap. Now, the probability for this fair value gap to hold price reduces when price closes below this fair value gap. So let's assume we have a candle here closing below this fair value gap. It reduces the probability. Okay. But if it closes below the midpoint of this fair value gap, which is also called the consequent encroachment, the probability still low, but increases. If you compare between these two, probability of this fair value gap holding price and this scenario is higher when compared to this scenario. Now, it even gets better when price closes above the consequent encroachment, like you can see here. Now we are using the bodies, not the wicks. Price wick through the fair value gap. You can see a mohawk here. Remember, the wicks do the damage, but the bodies tell the story. So we can see that price is closing above the consequent encroachment, making this fair value gap a high probability fair value gap. So here's another example you could see the high of this fair value gap and then the low of this fair value gap. And here will be the midpoint. All right. Now you can see that price closed below the low of this fair value gap. So this is not a high priority fair value gap. Although we can see that price did rally from this point, but this is not a high priority fair value gap. But here is the high priority fair value gap. So now, how can you use this? Let's say, for instance, you took a trade here, you bought here, and then price rallied higher, retraced into this area of inefficiency, and then rallied higher again, and then retraced into this area of inefficiency. Now, currently you're watching price, and then you see that price created this wick, and then went back into the fair value gap, then formed another candle, wick through it, did not go below the consequent encroachment or the wick or the midpoint, and then rallied higher like you see. You'll be confident to leave the trade to run fully. But let's assume this was where you bought, and then you are seeing this fair value gap, and price creates a candle that closes below the fair value gap, then another candle that closes below the fair value gap. It is an indication telling you that this fair value gap might not hold price, and you should be willing or getting ready to take out partials from the trade. It could as well be used in higher time frames. Let me explain what I mean. Let's assume this is a higher time frame and you are looking to buy in a lower time frame. So let's say this is a daily time frame. When you open your chart and you see this, you see how price strongly reacts. Let's assume this day is a Tuesday. You can see how price respected this fair value gap. It did not close below the consequent encroachment of the fair value gap, and it also did not close outside the fair value gap, that is below the fair value gap. You would trust that this day would be bullish because why? This fair value gap seems to be holding price, telling you that it's a high probability fair value gap. The second quality you want to look out for to tell you that the fair value gap is a high probability fair value gap is if you are buying, you want to look out for fair value gaps at a discount. If you are selling, you want to look for fair value gap at a premium. So how do we get a discount? How do we get a premium? When price creates a range, like you can see here, this is a range. From this high to this low is a range. From this high to this low is also a range. So a range is formed by opposite swing points. So here's a swing point, here's a swing point, here's a swing point. A swing point is formed by 3 candles. When the candle at the middle is higher than both candles by left and right for a swing high, and for a swing low when the candle at the middle is lower than candles by the left and right. So here's a range. To get the premium and discount, you want to take your Fibonacci, place it at the high and the low. The midpoint is called equilibrium, like you can see here. Above equilibrium is called premium, and below equilibrium is called discount. So if you are buying, you want to look for fair value gaps found at a discount. And if you are selling, you need to look for fair value gaps at a premium. So you can see that there's a fair value gap here. Imagine you bought here. This fair value gap is at a premium. You can see our price traded through it. It did not respect this fair value gap. What was it running for? It was running for this fair value gap. This fair value gap was found at a discount, and you can see our price rallied higher. The second thing I'm going to mention about using the fair value gap, you can use fair value gaps to time a reversal. Let me show you what I mean. Fair value gaps are an indication of speed and momentum. And when you see speed and momentum in a particular direction, it's a telltale sign that price wants to keep going in that direction. All right. Now, if you look at how price broke away from this range, you can see that it left a fair value gap. So I'll expand so that we'll see it. So as it broke, it left a fair value gap. So telling you that there is speed and momentum here. And you can see how price returned to continue this trend. All right. Now, when a reversal is about to happen, usually you don't see fair value gaps when the low or high is broken. Let me explain. Now you can see from this area of consolidation, as soon as price broke this area, so I think I will just draw it out. You can see that this was an area of consolidation from the low to the high. So you can see as it broke away, it left a fair value gap. Now, price retraced into that fair value gap and continued going lower. Now, as soon as price also broke this low, what did it do? It left what fair, you can see the fair value gap here. I just hope you guys can see. So here's a fair value gap. So price retraced and then broke this low. As it broke this low, took out the sell side liquidity, it left with a fair value gap, telling you that price want to keep going lower. Now, as soon as price broke this low, you can see that it did not leave a fair value gap. Instead, it left a wick. So as it broke this low, no fair value gap was here. It just left a wick. And you can see how price reversed. Here again, you can see how price took out this low. Because by now, if you have watched my previous video on reversal, you should understand what a reversal is. A reversal is when price takes liquidity and moves in the opposite direction. You can see how price was going higher, took out liquidity, and then changed direction to start going lower. That is what a reversal is. A reversal is always paired with liquidity pool. Now you can see as price took out this high. One of the ways to know that price will not continue going higher is if it does not leave a fair value gap. Price does not spend too much time after taking liquidity. If you look at this point here, you can see how price kept going lower, leaving fair value gaps, spent a lot of time below this low. But here you can see as soon as it took this high, it did not spend much time. It left quickly, okay? And it did not leave fair value gap as it was breaking the high, thinking that price does not want to continue. Now let me show you where price took liquidity and left fair value gap. You can see how price took out this buy side liquidity and also this buy side liquidity. As it was doing that, it left a fair value gap, thinking that there's momentum on speed. And you can see how price retraced, rallied. Let's look for another example. Okay, here's a very good example. As soon as it broke this low, you can see this low. Below this low, can you see any fair value gap? Nope. As price was running, although there's a fair value gap here, but it's not outside the range. So what I'm talking about is as price breaks the range or breaks the low, we want to see it create a fair value gap. So we don't see any fair value gap here. You can see how price reversed. The same thing here. So I want to show you where we could see a fair value gap and price continued. So you can see here as price broke this low, you can see it left lots of fair value gap before breaking and after it broke it. So you can see here's a fair value gap, here's another fair value gap. You can see how price returned. Let me expand. Price returned. So you can see here's a volume imbalance. Price returned into the volume imbalance and then traded lower. And then let's see if we can find one more example and that'll be all. So you can see how price broke this high. It broke this high. And as it was breaking it, it left fair value gap. Price retraced, rallied, and then it took this high again. In breaking it, what did it do? It left fair value gap. It also left volume imbalance. You can see how price went back into this area of inefficiency before rallying higher. Now you can see another beautiful break here. It broke this high and then did what? In breaking it, it left a fair value gap. You can see how price returned to fair value gap and then rallied higher. In conclusion, market inefficiencies are simply imbalances in price. Main types include fair value gap, volume imbalance, and price gap. Among these, fair value gaps are the strongest PDRA. Fair value gaps provide the best opportunities for both entries and targets. All right, I hope this video was helpful. Please, if you enjoyed this video, give us a thumbs up. And if you want to see more of this episode, please do subscribe if you haven't subscribed yet. All right, see you guys next week.